A beautiful day to buy a space, a beautiful day for a brand new place. Would you be mine? Could you be mine? Won't you be my neighbor? Won't you please? Won't you please? Please won't you be my neighbor? Hello, neighbor. I'm glad we're together again today. Thanks for joining me on Mortgages Made Simple. I'm John Lanzone, your caffeinated mortgage lender, and today we're going to talk about the difference between interest rates and APR. Though I assure you that interest rates and APR are only part of the equation, interest rates are all anybody cares about these days. But what's the difference? The interest rate, or the note rate, is the base interest rate on your loan. Think of it as the price of a shot of espresso. It's complex in flavor, yet one simple ingredient. Now the APR, or annual percentage rate, includes upfront costs, like the price of a fancy latte with all the add-ons. The APR includes additional lender fees for things like mortgage insurance, discount points, mortgage origination fees, and even other closing costs like your local government taxes. The APR at times can provide a more complete picture of the true cost of the loan over time, especially when you're comparing loan options of one loan type to another from the same lender. It helps you understand how much you'll pay in total. For example, the interest rate quoted for an FHA mortgage could appear enticingly low. But because an FHA loan requires annual mortgage insurance, which is about 0.55% of the loan amount each year, its APR will often be higher than the conventional loan. The tricky thing though, just like lattes, not all APRs are created equal. In other words, not all lenders calculate APR the same way and include the same fees in their calculation. So it's not always an apples to apples or a latte to latte comparison. You have to look at the interest rate and the total upfront fees too. It's like trying to compare the price of a latte from different coffee shops without knowing the quality of ingredients or what extras are included. The rate you saw online might look good, but it could be like comparing a fancy latte to that thing you get at a gas station by pushing a button. There are also other reasons the APR might not be a realistic way to compare costs of the loan. That's because the APR makes a few big assumptions. First, the APR assumes that you'll keep your loan for its full term. Second, the APR assumes you won't sell or refinance. And third, the APR assumes you won't pay off the loan early. Most borrowers, however, do not pay off their mortgage in full. It's typical to sell or refinance after only a few years, so comparing loan options based on the long-term cost might not make sense. Here are a few key actions to take. First, examine the interest rate and APRs. When you're thinking about interest rate versus APR, remember it's not one or the other. You can or should consider both. Second, ask for a breakdown. Don't be afraid to ask lenders for a detailed breakdown of what's included in the APR or evaluate the true cost of the loan. This way you can identify any hidden fees or charges. Third, consider your timeline. Think about how long you plan to stay in the home. If you're planning to move or refinance within a few years, focus more on the interest rate. For long-term plans, APR might be more important. Check the 5-year cost projection. For a more realistic short-term comparison, look up the 5-year cost projection on page 3 of your loan estimate. This shows the real cost of your loan after 5 years, including principal, interest, and upfront costs. Well, that's it for today's episode of Mortgages Made Simple, where I have your best interest at heart. If you've enjoyed this brew of information, hit that like button, share it with your friends, and subscribe for more tips to make your home buying journey a breeze. See you next time.